Central banks are quietly dumping US Treasuries for gold at a historic rate, and almost nobody is talking about it. Welcome to the deep dive. Today we are looking at the June 2026 editions of Purvang Gandhi's The Regime Report, and honestly, it is throwing massive red flags.
Yeah, huge red flags.
Right. Red flags regarding the AI boom, sudden global wealth shifts, and these incredibly violent oil spikes.
Yeah, and the thread tying all these alarms together is what the report calls the 3 Ins framework. It's a diagnostic tool that looks past daily stock prices to analyze three critical layers. You've got internal momentum, inflation forces, and institutional capital flow.
Well, let's start with that internal momentum layer, because the S&P 500 just snapped a 9-day win streak after AI giants Broadcom and CrowdStrike, they missed their sky-high expectations.
All right, they really fell short.
But wait, if the Dow just hit an all-time record high at the exact same time, how can the framework claim the market is losing power? That sounds totally contradictory to me.
I know it seems totally backwards until you look under the hood using a metric called the ADX. That is the average directional index. It basically mathematically calculates the underlying strength of a trend, regardless of whether the price is actually going up or down.
Okay, so if we picture the stock market as a bullet train, the ADX isn't the throttle, right? It's more like the internal RPM gauge.
Exactly.
The scenery outside might still look like a blur because prices are high, but the internal instruments show the engine's RPMs are quietly dropping. Is that it?
That is spot on. The ADX flashed a momentum fade signal, so the internal energy was draining. But, we didn't see the capital just vanish into thin air.
Right, it has to go somewhere.
Exactly. We saw an institutional shift. Capital fled those hyper-extended tech stocks and rotated into defensive sectors, things like healthcare and financials. Basically, passengers just moved to a safer train car.
And they are seeking safety because the traditional economic tracks are looking a bit warped right now. We have fresh missile strikes in the Middle East, the fragile Iran ceasefire is collapsing,
Yeah, it's a mess.
and WTI crude oil is just whipping violently on every headline. So is this a new structural bull market for oil or just knee-jerk panic?
Well, the framework categorizes oil right now strictly as a ranging regime. It is not trending at all. It is trading purely on binary geopolitical outcomes.
Ah, I see.
So if you try to apply normal trend-following tools here, you will absolutely get whipsawed.
Right, so you buy the breakout and it immediately reverses when a ceasefire rumor hits the newswire.
Exactly. Which is why the smart money looks at the physical data instead. Beneath all that volatile headline noise, U.S. crude inventories have quietly dropped for 6 consecutive weeks.
Wait, 6 weeks?
Yeah, 6 weeks straight.
Yeah.
So a very real structural supply deficit is building underneath it all, and that threatens to keep inflation really sticky.
And that sticky inflation creates a brutal trap for the Federal Reserve. They can't easily cut interest rates if oil is driving prices back up,
No, they really can't.
which is pushing Treasury yields near 4.5%. And historically, that crushes gold. In fact, gold is currently testing its 200-day moving average, which is a massive algorithmic and psychological threshold for traders.
It is, but defying that short-term yield pressure, we actually hit that historic milestone you mentioned at the start of the deep dive. Gold just officially overtook U.S. Treasuries as the largest reserve asset held by central banks globally.
Wow, really?
Yeah, it jumped to 27% compared to Treasuries at 22%.
That is wild.
Yeah.
But why are central banks making that massive swap right now?
Well, it is a profound institutional hedge. Countries are de-dollarizing to protect themselves against U.S. inflation and, the potential for geopolitical sanctions.
Yeah, that makes perfect sense.
They are building a hard asset safety net
Yeah.
and completely ignoring the daily price charts.
Wow. So all of these underlying tensions, the fading tech momentum, the structural oil deficit, the central bank gold rush, they really all converge on Friday's U.S. non-farm payrolls jobs report.
Oh, absolutely. The entire market is holding its breath for that jobs data. What we really need is a Goldilocks print.
Meaning what, exactly?
Meaning the numbers show a soft landing, not too hot to force rate hikes and not too cold to spark recession fears. But to see what the market truly believes, you have to ignore the immediate stock futures.
Okay, so what should we watch instead?
Watch the 10-year Treasury yield the very second that number drops.
The yield is the real lie detector test. Well, while you're watching those numbers, consider one final puzzle from the report. Keep an eye on the copper-to-gold ratio.
Oh yeah, that is a big one.
It is nearing a rare extreme threshold. While everyone is glued to AI stock tickers, just ask yourself why Dr. Copper, the ultimate industrial metal, is crashing while safe haven gold is surging. We will let you do the math on what that means for the global economy.